David R. Guttery is the president of Keystone Financial Services in Trussville, Alabama. David Guttery is a financial advisor who represents Emeritus Investment Company, LLC, and Emeritus Advisory Services. Please stay tuned through the end of the video for additional important disclosure information.
Hello everyone, I'm joined today by David Guttery, President of Keystone Financial Group here in Trussville, to share his thoughts about current market and economic conditions as we begin the new year. David, thanks so much for being with us today. You know, within many of your videos in 2022, you described last year as being a cascade of unusual events, resulting from the Federal Reserve's oddly hawkish approach to contracting economic activity. In your opinion, will this continue in the new year, and what are your expectations for 2023?
I celebrated my 31st anniversary of being in practice in December of last year. Across all of those years, in my opinion, 2022 will certainly be remembered as the most unique year that demanded an extraordinary effort to navigate unusual circumstances. Before we delve into my thoughts for the coming year, let's briefly recap what made the previous year so odd. Within last month's video, I suggested that if I had to caption the behavior of markets in the previous year, that I would describe it as being shocked. In November of 2021, the Federal Reserve began to nebulously hint at the thought of tapering. By January of 2022, they described the process of tightening with an equally non-committal description. Simultaneously, we were hearing about the transient nature of inflation. Well, if tightening is the process through which inflation is controlled, and both the Department of the Treasury and the Federal Reserve are suggesting that inflation is short-term and transient, then I believe that markets anticipated that any subsequent approach to tightening would be mild. Then in March of last year, the Federal Reserve rolled out what has proven to be the most aggressive approach to tightening in the last 35 years. I don't believe that this is what the markets anticipated, and it galvanized the attention of the markets. Rather than focusing on the coming years, markets became very fixated on the coming days. And when markets become short-sighted, it becomes increasingly easy to overly price nefarious assumptions into current valuations. As the Federal Reserve tightened throughout the year, among other things, this involved the selling of Treasury securities in the open global market that were purchased with printed money over the previous 30 months. As this occurred, prices dropped sharply and yields rose sharply. This resulted in a yield curve that hasn't been this inverted since 1981. For context, I was in the 6th grade the last time that happened. Clearly, this has created a significant and unique challenge with regard to the fixed income portions of our portfolios. Normally, when building sleeves of fixed income into portfolios, we are looking for negative correlation, meaning we are looking for an element of the portfolio that will add buoyancy during times of volatility. In most years, we are able to obtain that from a laddered sleeve of fixed income bond investments, and in particular, treasuries. Well, we weren't able to achieve that last year as bonds and stocks became positively correlated for the first time since 1972. Again, for context, I was 3 years old at that point. Indeed, it's rare to see Treasury securities post 2 consecutive years of negative results. That's only happened 3 times since 1928. Prior to 2022, the last time we observed Treasury securities posting losses in consecutive years was in 1959. Again, for context, my parents weren't even dating at that point. In the 3rd quarter of 2022, the Bureau of Labor and Statistics told us that inflation at the consumer level reached a point that we had not seen previously since the year 1980. As this was happening, we observed almost a new record high in terms of strength, dollar strength against the global basket of currencies. This is extremely odd when simultaneously dealing with a 42-year high on consumer price inflation. In October, the University of Michigan's Consumer Sentiment Survey posted the lowest reading in the history of the metric going back to 1960. If you think of a string of dominoes, when one is set into motion, the rest of the dominoes will be impacted, setting off a chain reaction. The actions of the Federal Reserve were driven by the need to arrest not only a historically bloated balance sheet, but also to arrest a historically high amount of money in the lendable system. This excess money and bloated balance sheet were necessitated by congressional measures taken to support an economy that had shut down for the first time in history over a disease that no one had heard of prior to 2019. I could go on, but you get the point. These are just a handful of occurrences that we had either never seen before or had not seen in many decades. Anecdotal evidence comes at a premium during such times. It's hard to glean insight into what might happen next from historical evidence when there isn't any or very little. So I would characterize last year as being a shocked market amid extremely unusual economic developments. With that context, we can begin to imagine how the current year may unfold.
Well, David, as we enter the new year, to what degree can you see this unusual environment continuing? Or do you see any encouraging signs that markets and economic conditions may be starting to stabilize?
Actually, yes. With regard to market volatility, if there is any anecdotal evidence to suggest that markets may have found their bottom, it would be in the form of capitulation. At a high level, this is the average market participant hitting a point of emotional exhaustion and just locking in the losses. Get me out. Quantitatively, capitulation, in my opinion, looks like this. At the end of September, we had an extremely high ratio of open put options to open call options. On the top chart, you can see that this peaked at the end of September. And furthermore, it was the highest indication of volatility that we had seen since COVID caused the economy to shut down. On the bottom chart, bearish sentiment had not been this strong since September of 2008, at the beginning of the Great Recession. In and of itself, this really isn't enough to feel comfortable that markets may have found their bottom. We must cross-check that with other quantifiable metrics. Taking a stochastic look at the market, it would appear that we bounced off the same Bollinger Band on 4 occasions last year, in February, and again in May, and again in July, and finally again in September. A double bottom is certainly encouraging. A triple bottom is very exciting. A quadruple bottom, in terms of stochastic analysis, is very rare. If you see one, you should pay attention to what the market is telling you by its actions. It's even more rare to observe a quadruple bottom within the same year. I didn't draw this chart. The market drew this chart with its actions. Stochastics at a high level is a fancy way of saying, let's play connect the dots. You observe patterns of behavior and you plot those dots. Connecting those dots form what we call Bollinger Bands. In the media, when you hear that markets are running into support or resistance, it is to such Bollinger Bands that reference is being made. So as it pertains to market volatility, in my opinion, I do believe that markets have found their bottom, and we have stochastic evidence to support that conclusion. Volatility will likely be elevated through the first half of the new year, but I also believe that it could abate from these elevated levels over the latter half of the year.
David, you mentioned in previous videos that the strength of the dollar had also contributed to the repricing of equity risk last year. Does that seem to be subsiding as well?
Yes, it does. In previous videos, I mentioned that a strengthening dollar can negatively impact assumptions of earnings when weaker foreign currencies are used to purchase a company's product in foreign markets. Throughout the year, as the Fed continued to follow a policy that was more restrictive than any other seen in the last 3 decades, the dollar became very strong against the global basket. Since the November meeting of the Federal Reserve, however, the dollar has relinquished quite a bit of this strength. If you'll recall in the video from October, I offered my opinion that the Federal Reserve would find the latitude to acquiesce and pursue targets of tightening at a slower pace. I suggested that if this happened, we might observe the dollar relinquishing some of the strength that had caused markets to negatively reprice for the risk that foreign revenues would be lower than anticipated. Indeed, we have seen this happen, and I believe that such will continue in the new year. And further, I believe this will be a positive around which markets can continue to coalesce.
So in closing, would it be fair to say that you believe markets may have bottomed, but not necessarily the economy? Can the market recover losses from the previous year if the economy hasn't yet found its bottom?
That's exactly my impression. I believe that last year, when markets became very short-sighted, that overly nefarious assumptions were priced into the market with regard to economic activity. These assumptions were predicate on the thought that central bankers across the globe would follow prescribed targets of tightening without regard for evidence of economic deterioration. On many occasions last year, I suggested that I thought this belief was irrational. Said another way, I believe that markets priced into themselves the likelihood of a very deep and long recession. I do believe that eventually the National Bureau of Economic Research will confirm that we are in a recession, but I believe it will be a shallow recession and relatively long in duration. So yes, I do believe that markets can continue to positively reprice for the risk that previously made assumptions went too far. That does not necessarily mean that the economy has bottomed, but I also don't believe that this will be the kind of 2008-style recession that the markets were expecting. Frankly, there are some signs of good news on the inflation front. Recently, respondents to the ISM Manufacturing Survey reported that commodities reported in short supply were declining, and commodities reported up in price were also declining. Said another way, the materials that go into the making of this pen are becoming more plentiful and less costly. The good news is that I assume I should be able to buy this pen for a lower price in a few months. However, the majority of inflation, according to the Federal Reserve, seems to be rooted in places such as food, fuel, health care, and shelter, and by its own admission, the Federal Reserve can do little to impact inflation at these levels with monetary policy. So yes, it will take time, but it appears that we seem to be moving in the right direction. Having said that, at a high level, I would suggest that it is still prudent to remain more defensively invested in companies that manufacture products and deliver services that are durable in nature, rather than having overweighted positions in companies that produce discretionary things. Said another way, invest in the companies that make the toothpaste and the shaving cream and the ibuprofen and food staples. At this point, I would avoid companies that make the things that you don't necessarily have to have. This strategy worked well last year, and I believe it will continue to be of value as the new year unfolds. Finally, I would just like to stress that everyone should be most concerned with the fruition of planning objectives and where they stand in relation to those objectives, more so than what the Fed said last month or how the market might react in response. The allocation of your portfolio should not be static, it should be fluid and reflect where we are economically, but the primary concern should be, are you still moving forward toward the attainment of stated goals? When you can take this kind of holistic view, it helps a lot with the emotional management of a volatile market.
Well, David, as always, thanks so much for this information today. And for additional information, David may be reached through the means listed upon the following screen. For the Trustful Tribune, I'm Brandon Dawkins.
David Guttery independently offers securities and investment advisory services through Ameritas Investment Company, LLC, member FINRA, SIPC, and Ameritas Advisory Services. Information provided in today's segment is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed and should not be interpreted as tax or legal advice. Any performance stated is past performance and is not indicative of future results.